Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, May 18, 2017. Looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. And we had a nice little snapback today from yesterday's decline. Under normal conditions with a down day like yesterday, a 90% down day, we'll generally either have a pause day where the market finishes pretty flat, or we'll have some follow through on the downside, which wasn't out of the question, and that could have very well happened. However, we intraday here, we had some kind of news hit the wire about Trump and Comey and all that nonsense. I don't want to get political on you. All I'm saying is it's just ironic how these news items tend to hit during options expiration week, which is another thing I want to discuss. So think about this for a second. So remember how I always say that the professional options traders at the institutional options desks, okay, their job is to make money this week. This is where they get paid. This is the bread and butter week. So think about this for a second. You had a lot of calls being bought in the market over the last week or so, specifically even on Monday of this week. And then all of a sudden, out of nowhere, the market falls out of bed yesterday. So those calls that were bought earlier in the week are going to expire worthless unless we have some miraculous rally higher, right? And that's unlikely to happen. So they're going to expire worthless. And then think about the retail trader, or traders, I should say, the individual investors, the unassuming trader that bought puts yesterday thinking the market was going to collapse and continue down further. Those are going to expire worthless most likely too, because they probably bought them close to the lows yesterday. As everybody begins to panic, the news gets bearish, and then it causes the individual investor or the retail trader to make a reactionary move on that news, and they tend to buy puts under those conditions. It happens over and over and over again. They tend to do the wrong thing at the wrong time, and we've all done that, and we have to learn from our mistakes. Hopefully nobody here is doing that, but certainly we've all done that, and that's how we learn from our mistakes. The people that don't learn from their mistakes are the ones that have to leave the business because they blow up their accounts or for one reason or another. They just can't make money doing it. So let's get back to today's snapback. So it wasn't a tremendous rally, but nevertheless, we had the broker-dealers up 0.5%. We had the transports up. We'll talk about that in a minute. We had the S&P up, almost 9 points, the cash index. You can see here the Spiders was up 87 cents or 1/3%, a little more than that, which is not bad. Okay, we were up more earlier when some news hit the wire, but then we pulled back. But all in all, when you look at the hourly chart, okay, we'll come back to the daily in a second, but when you look at the hourly chart, here's a thrust up, a little pullback move, another up move, and now we're in the middle of another pullback. So if we stay inside of this green candle here, where the low is 236.10 on an hourly chart closing basis, the odds are that we're going to have another move higher. Now, if we close below that low, then we're going to go down and retest the lows and most likely go lower. And when we get back to the daily chart, I'll talk about where that level is. But if we don't, and we end up with another candle or two, for example, towards the low of this green candle, and it holds, then we have another move higher in the cards, okay? We don't know exactly which one's going to happen yet, but let's go back to the daily chart and let's talk about the what ifs. What if the market failed and it didn't move higher and we did go lower? Where's that level? It really hasn't changed since last night. I'm in the 234 camp. Could be 25 to 50 cents on either side of that, but I don't see any more downside on this move than that. So we'll leave it at that. So yeah, that's a nice move down from where we are. Could be another 25 S&P handles, for example, give or take. And that certainly would scare the markets again. But I don't see any more downside coming than 234, maybe, into the 233s, but not much lower than that. And I think this area down here will become supportive of the market. Now, if we rally and we close back above These pivot lows, for example, on a daily chart, okay? So, for example, here's a pivot low of 237.70. This one comes in at 237.78. If we close above 237.70, that'll get us back into this range, and that will take off the downside temporarily at minimum. And that'll be very important by tomorrow's close because it's the weekly close. Okay, so there's your downside scenario and there's your upside scenario. In between, the market's just going to banter back and forth, and there's not much to do with it. But from a longer term perspective, we need to either be higher above the pivot lows down here from this consolidation point, or if we trade lower, we'll find support at 234, give or take 50 cents on either side of that. Moving over to the IWM, we saw an update in the IWM today, but again, sold off. It was up more earlier, and it's the same scenario as the spider. We should find support if we sell again down here at this level. It may even go down as low as this pivot low that's at 232.40. But down in this general area, similar to the spider, is where we would find a low. Worst case is the 200 period moving average down at 131.10. We would only get there on a hard sell. I'm not sure that we can get there on this move, but that would be a safety net if this pivot low didn't hold, and I wouldn't expect us to close down there, but we could get down there on an intraday basis. The same thing applies on the upside. We have to get back above really what becomes the waterline here is the 50 period moving average. We'll call it 137. The market has to get back above 137 to take that downside off the table. Looking over at the transports, earlier today they made a run for the 200 period moving average, came up slightly short and rallied, just like the spider and just like the IWM, and then sold off in the latter part of the afternoon session. But however, it's the same thing. It's going to follow all the markets. They're all basically trading together. When the market has the day like it did yesterday and a snapback, or at least somewhat of a snapback like it did today, all the markets tend to trade together, and we're not really getting any information from leading or lagging indicators. For example, the transports or the IWM, everything was kind of inflating today a little bit, and everything was obviously deflating yesterday. It's more, the leading indicators are more useful when you have divergences because it kind of gives you a signal of what might be coming, and that's when we get the best use of them. But on a day like yesterday and a day like today, everything trades pretty much in tandem. So I think everybody gets the picture of the overall stock market. I'm not going to go over the NQ and the XBD today. It's all the same story. So let's jump over to gold. And with gold, we had a nice little decline today. Let me get rid of that. We don't need it. And, yesterday we talked about the fact that it overshot my upside target that was 1250. That 1250 was now, or we're now back inside of that. But we found support today at the 20 period moving average. But today was a nice, I'm not going to call it a reversal day, but it was a reversal nonetheless from the highs, trading back down to the 20 period moving average. It was about a $20 swing from high to low today. So that's a pretty good move for gold, considering yesterday we were up $25. So it's a decent wide-ranging day for gold, more than we generally get. But right now, there's nothing to do in gold. We have to see if it's going to put in either a bullish pattern, consolidate sideways to downward like in a wedge formation, potentially building some energy for higher prices, or are we going to come back down? And the telltale sign is, are we going to stay inside of this last green up candle, yesterday's up candle? If we do, then it tends to be more of a consolidation pattern, a bullish consolidation pattern. If we come down below that, then there's trouble in the gold market and will likely trade lower. But right now, there's really nothing to do from a longer term perspective. We need more information from gold, so we're going to give it another couple of days to tell us what its intentions are. We let the charts do the talking. The charts speak their own language. Our job is to interpret what they're saying. When you look over at silver today, it was more of a down day for silver than it was for gold. Yesterday, we talked about the fact that from the pivot low to yesterday's high was 7 days. We put in what I like to call a pseudo doji candle into the 20-period moving average, into resistance, and today we put in a sell day. So there's probably more downside in the cards for silver. However, we could also put in a bullish consolidation pattern for higher prices, and if we did trade higher, they'll want to make a run if they can build up enough energy for 1748. However, which is really, I should have just said the 50-period moving average. That's a moving target, so we'll just call it the 50-period moving average, which is downsloping currently. However, we're below all the moving averages. We weren't able to get above even the 20-period moving average. This is not really a bullish chart by any means. This is a bearish chart. All we really got in silver was a dead cat bounce. This is a bearish chart. Likely scenario is lower prices coming for silver. If we trade down towards the double bottom area here, the likely scenario is it doesn't hold and we actually trade lower. Okay, looking over at crude oil. What we've got here seems to be a cross between crude trying to grind higher and consolidating sideways. We're stuck in between the 50 and 20 period moving average. And if we consolidate in this zone for another couple of days or so, then it's likely building energy to trade higher. And like we discussed last night, and I'm not going to rehash the whole thing, we spent some time on it. This is the consolidation point that is a natural resistance point for the market. That's what we traded to. Now we're consolidating in that zone. If we stay up here and consolidate, that's the chart telling you that it wants to trade higher. It just doesn't have enough mustard in the jar right now in order to get any higher. It needs time. Time is more important than price, and therefore crude oil in this case needs time to consolidate, to build the energy to move higher. And that's basically where we are. So right now, needs another couple of days or so of consolidation. And if we get that, it may be a long trade to the upside, getting up to the 52 area. Right now, it doesn't have enough time under its belt to get there. So the likely story is we continue to be somewhat trapped in between the moving averages as we are right now. Going over to the bond market. Bond market put in a pretty much a nothing day. It's a pause day. We didn't do anything. It's a pseudo doji candle, which is meaningless, right? We don't really take any stock in these that are in the middle of the ranges. I'm just bringing it up. We filled this gap here, and then we stalled out. And, you know, you can't make anything out of it yet. We had a big up day yesterday, and we had basically a flat day today. So if the bond market's going to move higher, it's going to have to consolidate most likely. It needs some more time, just like we just discussed with crude oil. So time is important. It needs either to consolidate up in this range or even make a wedge pattern, pulling back, consolidating inside of this large up green candle from yesterday. And if we can do that, then it also is building energy to trade up to potentially the 200 period moving average or slightly higher. And last but not least is the dollar. The dollar had an up move today, and whether yesterday or today, I guess today, early today, was the potential low, we'll see. This isn't really a reversal candle. If we finished either at or above yesterday's high, that would constitute a reversal, but that didn't happen. So there could be some bantering back and forth down here. However, this is the zone where we want to be looking to pick up the dollar to trade higher on a long-term basis, meaning this is a multi-month trade going back up to and most likely above the 105 area. We've been talking about this for a long, long time. This is the zone I've been looking for. Whether or not it actually gets down to 97 or below, slightly below, is almost irrelevant at this point. We're low enough, and the dollar has high enough to go long term where the distance between where we are and 97 really is not going to matter long term. But this is the zone where we should find low in the dollar. And with that, folks, it's everything I wanted to discuss tonight. It's a little bit of a shorter video, but that's fine. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.